There's so much misinformation out there on social media about how gold and silver are taxed. And a lot of you have bought gold and silver years ago. It's gone way up over the last 12 months. Gold being well over $4,000 an ounce and silver being well over $50 an ounce. Both have set records. And so people are thinking, well, should I sell some of it and take some of my profits? And then the question comes up, what are the tax consequences of doing that? Because I only get what's left over after tax. I want to dispel some of the myths out there. And the first myth is if you own US gold coins, that when you sell them, the gain is not taxable. That is false. So if you were to sell them at face value or use them like currency, in other words, if you had a American silver eagle and it's a $1 silver eagle and you spent it and got $1 of value, there would be no tax on that. But why would you do that when it's worth $52? Nobody is going to do that. So yes, it is legal tender if used as legal tender. But if you're selling it because of the silver value, that is different. That is absolutely subject to capital gains. Now, if you've held it for more than a year, it's long-term capital gains. And the same is true for gold. Now, the second myth is the dealers don't have to report it to the IRS if it's outside certain parameters. Okay, well, that may be true, but that's irrelevant. Whether they report it or not does not make it taxable or not. I want to be really clear. The tax law is very clear on this point. All income is taxable unless there is a specific exclusion from taxability. Let me give you an example of an exclusion. So life insurance, when you receive the proceeds of life insurance, that is specifically excluded from taxable income. Or if you get reimbursed for medical expenses, that's specifically excluded from taxable income. There is no specific exclusion for gold and silver or any other precious metals. One of the biggest problems with owning gold is storing that gold. You pay month after month just to keep it locked away and your stack never grows. But with monetary metals, the model is flipped. Instead of you paying fees, they actually pay you in gold to store your gold with them. That means your ounces go up every month. Now, how does that work? They lease your gold to qualified vetted businesses like jewelers, refiners, mints that need it for inventory to operate. In return, you earn a yield, typically 2 to 4% a year, paid directly in gold. Now, how is that possible? Well, everybody knows that if you're a retailer, wholesaler, etc., you have to maintain a certain amount of inventory on hand at all times. And rather than buying that inventory, they're leasing the inventory from you. So they have the gold there in their inventory for 12 months. And after 12 months, you can get it back or you can renew your lease. That's how it works. So for many investors, this simple shift, turning the cost of storage into a yield on their storage, is the difference between watching wealth erode and watching it compound. Monetary Metals has already completed over 75 deals across 5 continents with thousands of ounces paid out to clients, and so far, 0 losses. So if you own gold, ask yourself, why let it drain you when it could be working for you? Go to monetary-metals.com/CPA today and see how your ounces could start growing again. That's monetary-metals.com/CPA and let them know that I sent you. It's going to be taxed on the difference between what you paid for it and what you received for it. So if you paid, say you bought silver at $20 an ounce and you sold it at $50 an ounce, net of expenses, you're going to pay tax on $30 an ounce. That's what your tax is going to be. Now, the next one is, what's the tax rate? People have been misleading on social media. The tax rate is not the normal capital gains rate. I've seen a lot of videos saying, hey, it's not really a collectible. It's not really subject to the collectibles tax. So I want to be clear. The collectible issue is whether you can hold it in an IRA or 401k. Now, you can hold bullion, including regular gold coins and silver coins, in an IRA or in a 401k, as long as A, your administrator allows it, and B, you do not retain physical possession. If you have physical possession of the gold and silver, it's basically been distributed to you. If you have access to it, regular access, and it's not with the administrator and they don't have control over it, you're going to be taxed on it as if it were distributed to you. There was a court case not too long ago that made it very, very clear that this is the case. You cannot store your own gold and silver and treat it as being owned by your IRA or solo 401k. So that's the collectibles issue. Now, you cannot own a collectible in an IRA, like, for example, a gold coin with numismatic value. In other words, it's not the bullion value, it's a collectible. So maybe it's worth $10,000 because it's a rare coin. That you cannot own in an IRA. So be careful about terms here. Now, there is a special tax rate for gold and silver. It is 28%. On top of that, you could be subject to the investment income tax of 3.8%. Now, that depends on your level of income, so you'll need to talk to your tax advisor about that. But when you sell your gold or your silver, you should presume you're going to pay not just 28% from a federal tax standpoint, and this is, by the way, assuming you've held it for more than a year, but you will also pay your state tax. So it's very easy that you could be paying a third of your gains. Now, it's the gain, it's not the total price. So again, take that $30 a share gain on the silver. So you sold, let's say, 100 ounces of silver. So you have $3,000 of gain. Well, you would pay tax on $3,000 of gain. So if you're in, say, between state and federal, you're in a 33% tax bracket, you pay $1,000 of tax, you'd keep $2,000. So it's very important to understand how this is taxed. If you do not report it, that is fraudulent. This is tax evasion. We have two different types of reducing our taxes in the US. We have tax avoidance, which is legal, and sometimes we make mistakes, but they typically won't send you to prison for it. They're not going to call it fraud. However, if you sell your gold and silver and do not report it and you know it's taxable, that's fraud. That's tax fraud. That's tax evasion, and that is a very serious offense because it's not just a civil offense, it's a potentially a criminal offense. So please, 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 there are 1,000 ways to legitimately reduce your taxes legally, ethically, and morally. You do not need to cheat in order to properly reduce your taxes. You just need to understand the tax law and structure your affairs such that you pay less tax. So for example, had you bought that gold and silver in your IRA, when you sold it, it would not be subject to tax until you put the money out of the IRA, as long as if it had been held by the administrator under their control. Now, in a Roth IRA, same thing. So if you're thinking, hey, I think it's going to go way up in value, well, from here, then you might want to buy some within your IRA. You can hold bullion in an IRA. That includes recently minted gold and silver coins. Now, you could also just buy small bars like 10-ounce bars, but you cannot retain physical possession of it. You can't retain control of it. You have to request it if you want it, or you want it sold. You have to tell your IRA administrator that you want it sold. Now, what if you didn't hold it for a year? What if you've been trading in gold and silver, or you've been trading ETFs like SLV and GLD? If it's within a year, it's taxed at your ordinary income rates. It's short-term capital gain. No special treatment of short-term capital gain, except it can be offset by capital losses. Now, that's true even if you're in 28% gain. That gain can be offset by other capital losses from other sales. So let's say you sold real estate at a loss. Well, now you're going to get those losses, which would be capital losses, can offset the capital gain from your gold and silver. So remember that having capital losses it's bad to lose money. But from a tax standpoint, having capital losses is not all that bad because capital losses carry over forever. You never lose them. And when you do have a situation like this, you can now use those capital losses to offset the gain from your investments. So don't worry if you go, I have capital losses, I haven't used them. Don't worry about it. Just let them sit there until you have a need for them. They'll never disappear. They don't go away. You know, you're good as long as you're alive. They're good to go, and they're really a tax asset to you. So to recap, selling gold and silver at a gain is taxable. By the way, if you sold it at a loss, you'd get a capital loss. If you've held it for more than a year, It's a capital gain, but they have a special capital gains rate of 28% for gold and silver. If you want to hold it in an IRA, either a Roth IRA or a regular IRA, you can do so long as you do not retain physical possession of the gold and silver. So these are very important points to understand, because if you do it incorrectly, you will for sure have penalties and interest, and the IRS would be within their rights to assert tax fraud. What we don't want to do, above all, is something stupid that puts us in prison because we listen to somebody on social media.